I'm not God's gift to anything. I've made mistakes, so many of them that I can help you avoid the same potholes that I stepped into as a CEO. Building a successful company is not neat and orderly. It's chaos. It's absolute chaos, but it's controlled chaos. The train is going down the tracks. It might look like it's about to fall off, but it's not going to fall off the tracks. Inaction and being afraid to try something, that's what kills you. When you're running a business, take action, take strong action. You show me a stable company that has no chaos, and I'll show you a company that isn't growing, and it isn't disrupting, and it's not reinventing itself. Growth solves all of those problems. It creates the opportunity. It gives you, that increased profitability gives you the ability to pay higher wages, have better benefits, have good retirement plans, create opportunities for people.
Climbing up is a struggle, tension in the air, but the underdog prevails. We here to declare to the top of the mountain where champions stand. Failures can't break us, we taking command. Yeah, it's a journey, climb to the peak. Scaling businesses, who it ain't for the weak. Growth is the game, we play it real tall. From the bottom to the summit, we rise, never fall. Interview the legends, success stories told. Risepreneurs, hearts made of gold. Strategies unfold, in the struggle grace. Hardship and challenges, yeah, we still embrace.
Welcome back, everyone, to another episode of the Risepreneur Podcast, a show dedicated to all the entrepreneurs and business owners out there who's looking to grow, scale their businesses, looking to exit ultimately at the highest valuation. Today's guest is a very special guest. I've been waiting for this for a couple of months. Adam Coffey. He is a U.S. Army veteran. Very proud. Adam, thank you for your service. Love that. He's also a former GE executive. He's a founder of the Chairman Group. You're going to get to hear all the accomplishments now. He spent 21 years as a CEO building 3 national companies with 9 PE firms, completed over 50 acquisitions, had over $2.4 billion in successful exits. He is a best-selling author, number 1 best-selling author of 3 books. And the new one, the Private Equity Playbook, second edition, is coming out in 10 days or so. Be on the lookout for that. He's also on a mission to help all the business owners, private equity firms, executives to make a difference in this world, because at the end of the day, again, it's all up to entrepreneurs. I strongly believe in that. Adam, say hi and we'll begin.
Well, thank you for having me on. Hello to all your listeners out there. I'm pleased to be here, and I'm ready to dig in. Let's do this.
Yes. Can we go to the beginning stages? You've been in the Army, right? And then you were positioned yourself as an engineer, and you started to grow through corporate ladder. Can you give us an intro? Did you foresee? Was it intentional? How did you end up ultimately be hired by GE, where I believe all that transition started to fast forward for you?
I think life for all of us is a set of experience, and they're cumulative. They build on each other. And so if I go back to the young version of me who graduates high school and goes off into the military taught a young version of me something about teamwork, discipline, leadership, how to work closely with others, how to function as a team, how to accomplish, a mission regardless of how difficult it was, and how not to quit, and to just keep on fighting to get that end goal. Engineering made me a meticulous planner, always planning, and I was also a pilot. And pilots don't take off unless we know where we're going. And then we deconstruct the journey. Very helpful skill later on in my business life, especially when I'm running companies for private equity firms, because they're always about a 5-year hold period. They have a destination in mind. How are we going to get there from here? And so very useful skill. GE, I was at GE during the Camelot era. Is what I call it. So tech doesn't exist yet. Steve Jobs is either in his garage, or he's been fired at least once. But tech is just kind of a nascent thing. And, back in that day, GE's number 1 on the Fortune 500 list. Jack is the world's most admired CEO. That company's growing so fast, it's doubling in size every 2.8 years. And it was my 10 years at GE that kind of taught me so I became a turnaround guy, how to turn around a business. and how to get it to grow at a rate, that it had never seen before. And so GE taught me how to run a business. And then the 21 years building 3 different companies for 9 PE firms, multiple hold periods, different investors at different times, that's where, kind of the rubber hits the road. And, I learned by making mistakes, we were talking off camera and I said, I'm not God's gift to anything. I've made mistakes, so many of them that I can help you avoid the same potholes that I stepped into as a CEO. And, 21 years experience as a CEO. And then what happened was I got bored. I had been teaching at the university level for about 15 years. I was writing books and I was really enjoying giving back. That was fun. Being responsible for the tactical execution and building one company was getting boring after 21 years. And so I needed a different challenge. And so recently turned 60, decided I'm going to spend the last 10 years of my career teaching as many entrepreneurs as possible how to beat the odds and how to find success. And so I work more hours today than I ever did as a CEO, but I'm having fun again. It's definitely worth the time and effort that I'm putting in. Still writing, still teaching. I'm working with 68 founder-led companies right now, helping them scale, do M&A, helping them prepare for exit, most likely to private equity. I'm working with private equity firms. I'm helping them, figure out what to buy. And I sit on boards of their companies. I coach and mentor their CEOs, and so I'm still very much in that PE world, but now also working with 68 founders, and still teaching, writing, and teaching seminars globally, and in general, having a lot of fun.
Awesome. Would you say this is more fulfilling than being CEO?
It is. One question I get asked all the time is people say, hey, Adam, if you could live life over again or do it differently, what would you have done differently? And I said, well, first of all, I'm blessed. So I'm not, never second question any decision I ever made. But if I had it to do over again, I would have left being a CEO 10 years earlier, and instead of doing 21 years, maybe I did 10 or 11. And then started this adventure. I think I'm invested right now in 18 companies. I'm a limited partner in 4 PE firm funds. And so there's tons of opportunity once you take the blinders off. When I'm a CEO running one company, I've got to focus on my employees, on my company, on my shareholders. But when you take this off, all of a sudden there's all kinds of opportunities out there in the universe. And if I could do it over again, I'd have stopped being a CEO earlier. Yes, by far, much more fulfilling.
Probably now it's also more of like being a generalist again, right? Versus specializing all that focus into something one that you...
I am. I was talking to a PE firm earlier this morning, and they're doing something in roofing. And I work with 7 different roofing companies right now. I work with multiple companies in, so pick an industry. It's like I'm working with multiple companies. And so I'm getting a look under the hood of all these different kinds of companies in different industries. And the difference for me today is I'm not responsible for tactical execution. I help founders, entrepreneurs, PE firms with strategy. I coach and mentor their leadership teams, and I help them, put together the plans for tactical execution. But they're the ones who are responsible for making it happen. So lets me impact a broader amount of industries and companies simultaneously.
Yeah. And the expectation probably also for those business owners, entrepreneurs to also delegate it to their teammates and not to do all the tactical work themselves. So they would
I
be
try
more
really
strategic.
hard to drive home that point. It's a very good point, and I tell people that when you're an entrepreneur, getting out of the gates is difficult. There's 34 million small companies in the United States, and only 7% have $1 million in revenue, and only 4% of those get to 10 million. Only 40% of these small businesses are profitable. And so getting out of the gates is hard enough. And for most entrepreneurs, it's being, an anal retentive control freak that drives part of that success. But if you then find success and wish to get to a new level, you have to find a new entrepreneurial gear, and you have to learn how to go from being the first chair player in every section of an orchestra to becoming a conductor and hiring a team and empowering team and managing process rather than managing minutia. And those entrepreneurs that got out of the gates by managing minutia, if they can find that other gear and start managing process and empowering people, they're the ones who can then take a $10 million company to 100 million and beyond.
Awesome. Yeah, that's loaded. So let's unpack a little, unpack and go back to the mindset that you had. You started as a support as an engineer, right? Tech support to the engineers.
Yep.
Would you say you were detail-oriented, introverted?
I still am, to this day. My wife jokes, there's this famous movie with Julia Roberts, Sleeping with the Enemy, I think is what it's called. And she calls me Mr. Bernie, which is the guy the cans are all lined up on the shelf and the towels all come off the towel rod at the same length. I am still very much, a control freak, and I like order, and I don't, I thrive in chaos because I often walk into companies that are chaotic. But I organize chaos, and so I think, I'm still very much the meticulous planner that I always was, and it served me well, so I won't complain. But yeah, engineering, is kind of the catalyst. I still very much am that way. And you know what, my son, who is now getting ready to turn 40, he's actually a chief technology officer in a large private equity backed global software company. And so he's now living kind of that dream, he was the first kid to grow up on my lap with a computer, in his hands. And so now he's following in my footsteps. So I'd say that being strategic, being very methodical in your planning, that's one of the keys to finding entrepreneurial success.
Yeah. I think all the entrepreneurs, the way I see it, is that type of personalities that go into chaos and figure out how to create structure out of it. I mean, entrepreneurs from the point where, like, you position now as a CEO, when you were CEO, a conductor, right? Some founders, they attempt to do it, but they usually meet the limitation. There's only so much they can do.
I bought 58 companies, and the majority of them were kind of 10 to 30 million in revenue. There were a few that were over 100, but and I'd say in most cases, those entrepreneurs had kind of hit their own glass ceiling, and I would say in many respects, it was their own limitations that prevented further success. So they were very successful people, beat the odds, built a successful company, got to a certain size, and then just didn't know how to bust out of that ceiling and take it to a new place. And so that's usually where I step in, is when they're done. And if you look at the 58 companies I bought, vast majority would fit in that category.
Yeah. I heard you bring examples of Jeff Bezos and Elon Musk being minority shareholders. What also come to mind is Steve Jobs and Tim Cook, right? So Tim Cook was more of a conductor. If Steve Jobs would try to do it all himself instead of Tim Cook, probably would not be as effective.
Sure. There's a time and place for a different style of leadership. And, you mentioned Jeff and Elon, so I'll go ahead and just tell that little story. And a lot of entrepreneurs, they see an exit as the end of the road. They see it as the culmination of their efforts. And so I build a business, I'm going to sell it. It's the end. Give me all my money. I'll put it in a wheelbarrow and I'll walk off into the sunset and go do something else. And I tell people that's the wrong attitude. Selling your business is not necessarily the end. It can be the first rest stop on the wealth creation highway. And, I don't want to be a minority shareholder. Well, Jeff Bezos and Elon Musk, the two richest men on the planet, arguably, both own less than 13% of their respective companies. If it works for them, it can work really nice for you too. Don't limit your own potential by seeing an exit as the end. An exit is a wealth diversification event, an opportunity to take some chips off the table, invest it elsewhere, and then reinvest, playing with some house money now and using somebody else's wallet to continue the aggressive growing of the business. And, I think there's still tons of opportunity. Exits aren't the end.
This reminds me when we talk to sales teammates, when we talk about their commission going through different brackets. The higher you go in the brackets, the percentage diminishes. But focus should not be on percentage. Focus should be on the actual dollar amount, because dollar amount is usually much higher. So at
I
the end
tell
of the
people this all the time. If you can imagine an analogy for a company as being a truckload of grapes, and watermelons, it's like, would you rather own 100% of one grape, or 10% of a truck filled with watermelons, or thousands and tens of thousands of grapes? It's like it's everything is about perspective, and there's a lot of opportunity out there if we have the right mindset.
and that perspective dictates, right, the decisions. And
Sure.
if we're holding on to some wrong perspectives, you hit that ceiling plateau and you're not getting anywhere. All right, can we go to while you were at GE? You're very detailed, introverted, you climbing. How did you get to work under Jack Welch, and what was that like, that experience?
Well, so, I mean, Jack was a god, at that point, what I mean? And so he, in his 20 plus year career at the helm of GE, early days was kind of neutron Jack. It was the, we're going to be first, or second in any business, and huge, diverse set of businesses. And he's like a little kid in a toy box deciding, what do I want to keep? What am I going to get rid of? What am I going to focus on? What's the core? And so a lot of change, a lot of turmoil. Building a successful company is not neat and orderly. It's chaos. It's absolute chaos, but it's controlled chaos. The train is going down the tracks. It might look like it's about to fall off, but it's not going to fall off the tracks. It's a controlled chaos. And Jack inspired an entire generation of business leaders, not just those of us who were there, but also, other Fortune 500 companies wanted and sought to emulate. And still to this day, a lot of the practices that Jack kind of pioneered back then are still in common use today. And in a lot of areas, we've continued to progress. So for me, I was introverted. I still am. If you put me in a mixer in a room full of people, I'm going to be the guy sitting in the corner, nursing my glass of wine, or whatever. I'm not the guy who works the crowd, shaking hands, kissing babies. That's not me. I'm the quiet type. I'm the guy who doesn't hang out in the hotel bar. I'm the guy who goes up to his room, and so I avoid that is my natural instinct. But I did learn, as a CEO, how to articulate a vision and build a vision, to create this shared aspiration that employees would strive for. And so you see me on a stage, or you see me in my element, as a CEO, and people think, well, there's a guy who's an extrovert, a go-getter. And in reality, it's not the case at all. And, but I did learn, to have some arrogance and to have some fun in life. And I think all successful leaders at some level, there's a fine line there between arrogance and being confident, as an example. And so you have to know where that line is. And sometimes you have to dance with that line in order to inspire others to reach high levels. But at GE, I started by becoming a turnaround. I remember my corporate mentor, when I was starting early out, said, Adam, if I give you a high-performing business unit, we'll never know what you have. I'm going to give you the worst thing at GE, and there were 21 of these business units, and you're getting number 21 out of 21. And it's Wow. It's the armpit. And let's see what you got, kid. And in 12 months, I went from, my goal was worst to first. And I went from 21 to 3 in 12 months. I didn't quite get to number 1. There's always certain markets that just are doing phenomenal. I call that riding the wave. But I did go from 21 to 3, in 12 months. And so that cast my die lot as a turnaround guy. Even within a successful company like GE, there were business units that were underperforming. And so then for the rest of my career, people just kept giving me bigger things to fix. And every company I ran started as a company that was in trouble. It wasn't performing. The reason they brought me in as a CEO was not because the company was high performing and doing well. It was because somebody wasn't cutting the mustard and this company had lost its way. And so time for me, to come in and always fix something that's broken and then teach it how to grow like it's never grown before, and get everyone to kind of buy off on that vision for that journey. And I would say that I've never been the smartest guy on the planet. I know how to hire good people and articulate a vision, create a shared aspiration, and then get out of the way, and hold people accountable. But, it's like you also learn it's not about me, it's about we, building a team, and, we all play our roles and in success, and it takes a team of people. And, I think I learned how to, I was always a communicator. My dad was a Fortune 500 executive in sales and marketing. He was pretty polished speaker. And so I think at some level I had some God-given talent, but I learned how to use that talent, but I never really stopped, becoming, or being who I was, which is the introvert.
Mm-hmm. I'm thinking again, putting myself in your shoes, because I'm also an introvert and also very detailed, I guess.
But yet you host a podcast.
Yeah, I pushed myself. My
Yes.
kids actually challenged me, and I wanted to show them that it could be done. They wanted to become YouTubers, and they would keep on procrastinating. I'm like, okay, let's do this. I'll show you how it's done. And at the same time, giving back to community, connecting with other people. Yeah, for sure. When time calls for it, you got to do what you got to do.
Yeah.
I think for us introverts also, I think it's easier to communicate because everything has to make sense. So when we communicate, I guess when you're taking a role of a conductor, besides just being an inspiring leader, you also need to make sense. So when
and as I'm not even a big, I'll call it classical music fan, but I use that analogy quite a bit. And to the casual listener, you're sitting out in the crowd, and there's a guy up front, and he's doing his thing, and it's his timing, but you're like, well, he's not doing anything. He's not playing an instrument. But that, when done properly, that orchestra is responding to every move, and just like a coach of any sports team, it's like there is that role that's being played, and it's magical. And when you can learn how to be a conductor of an organization and get it to achieve things it's never done before. Every company I went into to run also had been in existence for 40 years before I got there. And I got all of them to grow at historic record pace. I often find when I'm working with companies that there is an ability to achieve a much higher level of success, but the individual has to see it, believe it, and then work to go and get it.
When you got that unit perform and put it as a number 3, what was the issue in this particular case? Was it people, processes? There was.
I largely did it without a wholesale change in people, in leadership. So in that case, it was a business unit that had lost its way and needed to learn how to win again. And so I would say there was GE actually ran kind of an experiment back in the day. And so there were three leaders in this business unit. I was what was commonly referred to as the rah-rah guy. So I'm the take the hill, paint the picture, articulate the vision, follow me. I'm the military guy who takes the hill from the front, not the back, and let me show you what we can become. But then we were matched with, I was matched with a very analytical person who was really, really strong from an analytical perspective, almost like the CFO, call it, of the business unit, who could look at the numbers and say, call it the FP&A type of effort, financial planning and analysis. Based on what I'm seeing, these are the key areas that if we make incremental improvements here, and here, we're going to get this desired outcome. And then I had another leader, and he was kind of the COO type, quiet, not quite as charismatic as me. And so he was, call it, the COO. So I'm like the mini CEO, who's articulating the vision, take the hill. I actually had a cult following radio show within GE. Before there was such a thing as a podcast, I used to host an internal radio show and I would bring in guests from the Fortune 500 and corporate world within GE, outside of GE, and I had a cult following all throughout GE. And so I was kind of the vision articulator, the rah-rah guy. Give me the analytics, give me then the operational, expert who can take the vision and make it happen. And so between the three of us, it was like a psychological profiling experiment at GE to see, through some key leadership changes, could we alter the outcome of an existing business unit that was underperforming? And we did. And I remember when we at one point we were number one in the country, and I walked into a board meeting and I had a boom box. This is back in the 80s, or 90s. And I had a boom box on my arm, wearing dark sunglasses, smoking a Cuban cigar. And I'm like, it's Pink Floyd's song Money. And my leadership team's walking in behind me, and we're throwing Monopoly money up in the air. And we literally had the board in stitches, and I remember Jack saying, Adam, it's a damn good thing you're number one, because if you weren't, that could have killed you, but it was like knowing how to have fun too. And so these were fun times, and learned a lot, but it was a good time. But, I cared about employees too. And so I would tell you that it wasn't as popular when I first became a CEO as it is today. Today, if we're going to build an empire, we're going to need people. We're going to need lots and lots of people. And people don't want to work. You said it yourself. Your kids, they want to be TikTok stars. I want to be a social media influencer. I want to do crap, and I want to make millions of dollars a year. It's hard to get people to work, in today's world. And if we're going to build a big company, we need people. And so we better be authentic when it comes to caring about people, their success. And so for me, all companies, all turnarounds, every business unit I ran, it went right back to being a squad leader in the military. And it's all about your people. And it's about, I'm going to build a strong culture. I'm going to get an engaged workforce. That workforce will work really, really hard for me. They'll take care of customers. Customers will love it. They'll give us more stuff, and revenue will rain from the sky. And so for me, I always saw people and culture as being the cornerstone of a turnaround and of finding an exceptional growth trajectory. And so it starts with culture. It ends with culture. Financial performance is an output, of culture.
Mm-hmm. Yeah, and now for sure hard, especially after COVID, it's tough to keep the culture and the peak performance in place like it used to be. And especially in GE,
it's tough, but it's doable. I used to do, I call them town halls, but once a month, I had 3,000 employees at the time. I'd do a town hall, and I'd have over 1,000 employees who would just pull over for 15 minutes to listen to me, and to stay connected to the people and the culture. So I would say it's a new wrinkle, it's a new challenge, but it can be done.
Mm-hmm. Awesome. So can we go to the being doubling business in 2.5 years? So that's rule of 72. So was it the 25 to 30% bracket annual growth?
So the basic math is, if I walked into any company, old company, been around 40 years, not performing very well, and I asked people, what's a good growth rate? Most people would coalesce around 10%. Sounds good, double digits, old company, mature industry, 10%, that's a good growth rate. And then I would tell people, 10% sucks. Based on the rule of 72, if I'm growing at 10%, it's going to take 7.2 years to double in size. So if I've got $1 million business, in 7 years, I've got a $2 million business. In 14 years, I got a $4 million business. And then in 21 years, I got an $8 million business. Compare and contrast that, growth rate with 30+%, which is what I learned from GE. I learned that from Jack. It's like, when you talk about the world's largest company, growing at such a pace that it's doubling in size every 2.8 years. If you reverse engineer that, that's a 30+% or organic growth rate in earnings. Not just revenue, but in earnings. And so once I got calibrated that's the good growth rate, I've been able to achieve that in every company that I've ever run, every business unit. It's 30% is the number I'm shooting for, 30% plus. This isn't the world of startups, where you go from $1 of revenue to $2, and that's 100% growth. No, This is 40-year-old companies going to learn how to grow at a pace to where it will double in size in 2.8 years. It'll triple in size in 4.2 years, and it will quadruple in size in just over 5 years. Magical number, because if you're running a business for private equity, the average hold period or the amount of time that they're going to own a business is 5 years. And if I play my playbook and get the growth rate that I'm targeting, I'm going to quadruple earnings in a 5-year period, and you're guaranteed a good outcome if you can pull that off. And if you can sustain it indefinitely, which is what Jack demanded, then you can continuously be hitting great outcomes for multiple ownership periods and big paydays for management and be able to have enough, I'll call it profitability within the business to invest in your employees and to keep that culture really strong and be able to demonstrate a high level of care for every employee in the company. So that's always been the magical number for me. And, I'm a cook in a kitchen. I have 3 ingredients. You want a good outcome, a good entrepreneurial outcome. You want 30+% growth in earnings every year forever. And you have 3 ingredients. I can grow organically. I can improve the margins of the business and revenue I've already got. And I can use mergers and acquisition. Those are my 3 ingredients. Sprinkled together, I need some balance. I can't be a one-trick pony, but with balance, I'm looking for 30%. Those are my 3 ingredients. Some combination of those 3 levers are going to lead me to the promised land every time.
Awesome. A few things that, again, I'm registering here. We're not talking about startups. So like you mentioned, 7% break the million, 4% out of that hits to 10 million. So that's extremely hard to get to 30%, right? Warren Buffett guarantees 21, I think, percent. And he's doing it, but without being physically involved in the business. Here you have to take basically active role as a CEO and have a strategy in place and culture in place and all the ingredients that you call in place for you to be at 30%. This also reminds me the 4-minute mile with Roger Bannister. To somebody who is already a seasoned entrepreneur, they might see it as a mission impossible. 30% every year, you got to be kidding me. But because you did it, right? So now
if the world's largest company can do it and sustain it for a 10-year plus period, so can you.
Yes, wow. Again, perspective, right? If you believe that, then you have. Can we dive in? I was dwelling on your book about the exit strategy. And there you define the different type of buyers, and you mentioned these ingredients as well. I believe the audience will appreciate those ingredients in more details. When we say organically, can you point out what exactly does that mean, organically?
Yeah. So for those who remember the movie The Wizard of Oz, the original, the 1939, I think it was, version, Oz at the end of the movie is exposed as a guy behind the curtain with a bunch of levers. And, anytime I'm running a company, I'm Oz. I'm the guy behind the curtain with the levers. And so I have the same levers in every company I've run. I work with 68 companies today. Same levers apply to those. Sometimes some are more in play than others, but generally speaking, if I go back to what are the basic levers that I need to understand and know how to set. Number 1, if I'm talking organic growth, price, volume, pivot. Price is the most underutilized lever in virtually every company I walk into. There's still price available. And so I have a product or service, and if I simply sell that same amount of volume at a higher price, it's going to yield higher profitability. In today's world, we're in a high inflationary type environment. Virtually everything on the planet is going up in price. Why isn't your product or service going up in price regularly too? I can't turn around without getting an email or a letter for, Netflix, my monthly subscription's going up, newspapers going up. It's like your TV subscription's going up for this. It's like everything's going up. And so it's the best air cover on the planet. And what I find is that most companies I'll just say, regardless of product or service, they use a cost plus model, which is absolutely flawed. So I have a cost of producing a product, a cost of a service that I have to provide. I add a margin on top, and that's where I'm going to price my product. Well, maybe my customer is willing to pay up here, but because I'm cost plus, I'm limiting my potential. I want to find the place where if I raise the cost of my product or service by some small incremental amount, the customer says no. And if I can find that spot, I'm going to get the maximum potential value for my product or service. And so price is always a big lever for me. And oftentimes in virtually every company I look at, nobody owns price. It's an arbitrary thing that gets set once in a while, but nobody is sitting there working price and trying to figure out where is the right place to price a product or service. So there's price, there's volume.
Wait, before we go to volume, can we touch on price? A lot of entrepreneurs are afraid to raise prices. They think that if I raise my prices, I might lose some customers. They don't.
You might. But here's a statistic for you. If I raise my price, marginally, let's say I raise my prices 10%. That's a pretty high number. I can lose 20% of my volume and still make the same amount of money. But now I'm doing less work, so my margin profile is different. But here's what I'll tell you: when you're running a business, passive is what kills you. Inaction is what kills you. If I have levers available, so I have to be able to measure my impact. So if I think about how many bids am I putting out, or proposals am I putting out, or how many widgets am I selling, and what's the average price per bid, and what's my close rate, I can now start maximizing price and start to try to find that sweet spot where price goes up and close rate starts to come down. And now I know I'm nearing, that maximizing of price elasticity, in a given marketplace for my product or service. And it's like I can use metrics, but I'll tell people, it's, inaction and being afraid to try something, that's what kills you. When you're running a business, take action, take strong action. Here's my 5 or 6 things I'm going to do. And now I'm going to look for measuring systems. I'm going to look at what impact this is having. And if if I overdrove one area, then I'll back off. But by taking the action, I'm constantly learning. I'm learning how to maximize the potential. So price, to me, every business I go to, most overlooked. Volume has to do with just re-engineering my sales process. I've recently worked with multiple companies where the lion's share of their revenue, I'm talking more than 50% of revenue, is coming from a segment that has no sales representation at all. I often find when I go into businesses as a consultant or when I was a CEO, I find that we're improperly, representing our product and service to the marketplace. We have way too much of this, none of that. And it's like, I always, part of my efforts always involve around blowing up the sales process and reconfiguring it, re-engineering it. Who's my customer? How do they buy? And then creating, a new model for sales that does a better job of aligning products and services to a marketplace. And then for me, price, volume, pivot is about making strategic pivots to the left or right of where your core revenue stream is, and think about it this way. What does my customer buy from me? What do they buy right before they come to me? What do they buy right after they leave me? How can I build a bigger ecosystem? Because the hardest thing for all of us to do is to actually find a customer. Once we find them, we want to sell them multiple products and services. We want to create an ecosystem around that customer's needs. And so I'm looking upstream, I'm looking downstream, I'm looking for more products and services that I can sell. Sometimes with a pivot, I'll buy a company. So maybe I'm an MSP in the technology space. I'm your cloud service provider, but I don't do security. So I buy a company that specializes in security. And now I go to all their customers, that's all they do, and I sell them cloud. I sell them all the products and services that come from my core business. And then I take all of their customers, sell them my stuff, and likewise, I go back to all my customers and I sell them this new product or service that I have available because I made a strategic pivot. And so my goal and objective is to sometimes increase my ability to serve, a given customer set with more products, more services to set up this cross-sell opportunity. You marry that with restructuring the sales effort so that I better align with how my customer wants to buy. And then I add price on top of this, price, volume, pivot. These are the ways to get organic revenue to much higher levels. Works everywhere I go. Margin, I've got revenue. We need to learn how to service it more efficiently. As we get bigger, our costs should be going down. I'm on the board of a flooring company. We buy a lot of material. Well, we're also doing a buy and build. So if I buy a company here and here and here, and I take all of our volume and combine it, I should be able to go back to the mills and the flooring manufacturers and say, hey, I'm buying 5 times the volume. And I expect, to be paying less per square foot for all the product that I buy. It's a natural thing. As I get bigger, I become more efficient. If I'm running a service business, I've got 1,900 trucks and I'm replacing 8% of them a year, if I'm going to buy 100 trucks, I'm going to get a lot better deal than if I buy 1 truck. And so it's, as we get bigger, we find scaling opportunities. That's margin improvement. And then finally, it's, in addition to that, hey, a lot of industries are highly fragmented. I'm doing 3 roll-ups right now in the bookkeeping, accounting, and payroll services type space. And there's 1.8 million small accounting, bookkeeping, and payroll service type companies in the United States today, 1.8 million. And because there's so many of them, there's not enough buyers to drive up the price. But as I put 20 or 30 of these together and I get scale, I'm getting bigger and I'm above the pack of the 34 million small companies. And there's only 3,000 companies at the top that have $1 billion in revenue. So 34 million small just in the US, only 3,000 on the planet with $1 billion in revenue. As I climb above the pack, I'm getting rare. And then bigger buyers swoop in, there's less to buy. And the multiples being paid go up dramatically. So buy and build gives me an ability to build scale faster than just pure organic, but I want to do both. I want to maximize price, volume, make strategic pivots, improve my margin and operating costs, and at the same time, bolt on other companies because it's so much faster to buy growth than it is to actually organically go around and open up a bunch of new offices or organically try to create a bunch of new products and services. And so there's a combination, same levers in every company, set slightly different based on industry I'm in, but those are the basic levers to drive, call it that 30+% growth rate.
Do you approach them all at once or one takes priority over the other?
I do approach most of them all simultaneously. And the reason is, unless I'm a small company that only has 5 employees, you're talking to a guy who goes into a company and I've got hundreds or thousands of employees. These are all different disciplines. And so people who work on improving margins are probably not the people who are trying to sell more volume. And so I can effectively work on several of these different areas simultaneously. And I will say this too. It's possible for me to grow a company faster than I historically did. But culture is the governor on how hard I push growth. Remember I said that growing in this fashion is chaotic. You show me a stable company that has no chaos, and I'll show you a company that isn't growing, and it isn't disrupting, and it's not reinventing itself. And as a matter of fact, long term, it's going to be in trouble, And so constantly testing, constantly pushing the envelope, it feels like the train's going to come off the track. When you are in that position, that's where the maximum trajectory of growth actually happens. It's a controlled chaos. And it is possible to push too hard, too fast. And so I'm backing off, not because I technically can't push harder, but because I got to make sure the culture stays and keeps up with me. Not everybody can function, in a highly chaotic environment. I'll go back to the military. If you can operate under fire in intense conditions, then you learn. You learn how this stuff works. And so again, everything I ever did in my life and my career is all additive. And it's cumulative, and it's all these experiences that allowed me to grow companies the way I did.
Yeah. So perspective of going to a workplace and having attention, that should be a default culture. Because if people avoid tension and they want to relax, looking forward to Friday because it's a weekend, and then hate Mondays because it's tension again, that company kind of will be more leaning towards being comfortable, not really growing.
Yes. Yeah. Again, growth is chaotic. I can't say it enough. And so get comfortable. If you're an entrepreneur and you're leading a business, live in the chaos, because that's where growth happens. And if it's stable, you're not growing. And one of the biggest problems I find with entrepreneur-led businesses, there's nobody to hold you accountable as a founder, as an entrepreneur. It's, hey, me, I screw up, I get fired. Jack doesn't like what's going on, you're gone. If I've got a board of directors, I'm running a company for a PE firm, if I'm not growing at the pace, that they need, I'm going to get whacked. Well, if you're an entrepreneur building a business and you don't have a boss, who's going to whack you if you're not performing? Mediocrity becomes acceptable to a lot of entrepreneurs rather than being forced. How am I going to find my way to that 30% growth? It's a down market. All of my competitors aren't doing very well either. So I'm okay. I'm okay if I don't grow this year. Well, not an acceptable answer. Who's pushing you? So if you don't have a boss or a board of directors, that's where peer groups or coaches or mentors, or somebody can help be that person to push you and hold you accountable so that you don't stop trying, so that you don't accept mediocrity and you keep on constantly trying. What can I do better today? The market threw me a curveball. Hey, COVID just hit. How do I become an essential business? Thank God I am an essential business, but how do I keep my volume up? What are the things that I'm going to do? And, the difference between, I think, finding a high level of success and just being successful on a mediocre level, it's not stopping, to challenge yourself and finding a way to hold yourself accountable.
Yeah. Two things. One is that the culture, when you mentioned that pressure, tension, is it on a leadership only, or?
No, it's the entire organization. Yeah. I'm one of these guys, go back to the GE days, pay for performance, and I mean, a lot of people would remember back to that era would remember the concept of ABC players and forced turnover, the bottom 10%. There was a lot of things Jack did that were pretty radical back in the day. And, after a few years of doing that, it's like there was no bottom 10%. It's like you had A's and B's, the C's were dead and gone. That had to moderate, it had to change. But, using metrics to hold people accountable. I want to create an environment where employees can spend their entire career. I have to pay a fair wage or I'm going to lose talent, good benefits, good retirement plans, and I have to create opportunity for those who wish to progress and get promotions. Growth solves all of those problems. It creates the opportunity. It gives you, that increased profitability gives you the ability to pay higher wages, have better benefits, have good retirement plans, create opportunities for people. It's like growth solves a lot of problems if you can find the growth. But we have to hold people accountable. So having a great culture doesn't mean that we coddle people. You don't have to be a tech company that has free daycare and yoga classes, at lunch and the smoothie bar, and you can have a great culture but still demand high performance from your employees. And they know that hey, I have to work hard. I can't mail it in here or I won't last. But if I do work hard, I will get promotions. I will get opportunities. I will get pay raises, and I will love being here. And so it's about instilling, a strong work ethic, holding people accountable to results, but then making sure that as an organization that we are plowing, some of our earnings back into our people to create, that strong, sustainable culture where people not only can win, but when we have openings, they bring their friends and they bring their family members, and when you're talking smack about the company you work for out there, on a Friday night with a beer in your hand, it's some people out there, you want them to be your advocate. No, I like where I work. I love what I do. We have openings. Maybe you should come work with us, and that's the kind of environment that I want to see. But it doesn't coddle people or let people survive in mediocrity. It holds people accountable, but it takes care of people who perform.
Wow. All right, so let's go to there's. I'm looking at the time, and there's still so much to ask. Can we touch on one subject? Let's say a business under $1 million, looking to grow, and they kind of tried things organically. They looked at the margins, so now they're like realizing, okay, I need to create opportunities for growth through acquisition because opening new location from scratch doesn't make sense. So what do they need to have in place in order for them to go and start looking, especially if they're not so equipped on the funding side, to go and start acquiring competitors or something that would be a supplementary to the offering?
Yeah, my last company that I built, we bought 23 companies in a 5-year period, and we used 100% debt, not a penny of equity. So it is possible to buy stuff with no money. I help people, I coach people do that every day. Capital helps, and strategic influx of capital at the right point in a buy and build can make huge differences in terms of returns. But there's always a way to find money. Money is a commodity. If you think that money is preventing you from succeeding, you don't know what your problem is, because there's trillions of it out there, and there's over 1 trillion of it right this second, looking for some deal or something to fund or something to buy. And so we just need to know where is capital, learn how to treat capital well. And if we don't have money, then we got to treat capital well in order to get someone to say yes. But ultimately, I'm going to use the cash flow inside the businesses that I'm acquiring to service the debt that's required while I'm collecting them and adding them to my base business, which is now growing faster, and has improved margins, doing all the other things that we talk about. But I'll tell you, M&A is the most powerful tool, and it is the number one way that private equity adds the majority of their returns. The majority of their returns in a PE fund doesn't come from organic growth or margin improvement. Those are components. The lion's share of value creation comes from arbitrage, which is putting a bunch of small companies together to create something bigger that's above the 34 million small companies, not quite to the billion, but it's above the pack. And as companies get bigger, they trade for higher multiples because there's fewer of them. And so M&A is that kind of the biggest tool. But it's the most powerful tool, but it's also the one that if it's wielded by someone who doesn't know how to do it, can do the most damage, and it can kill you, and your efforts overnight. M&A is a great tool for growth. I've built empires and had billions in exits as a result of that tool, but you need to know, how to wield it, how to use it. And, oftentimes I say it starts with a really good foundational understanding, of how M&A works, but then also understanding what good looks like. We don't want to buy a bunch of fixer-uppers and put them together. Life is too short for that. Arbitrage is naturally occurring. As we buy companies and we get bigger, we're more valuable. And that happens whether I buy good companies or bad companies. So why not just buy good companies? It's easier to integrate them. It's easier to work with entrepreneurs if you're collecting entrepreneurs as well, when they're all good people who think like you do, who love your culture, love their culture, and they're all committed to running a great business. Stay away from fixer-uppers. Know what good looks like. Avoid what I call as shiny penny syndrome. I'm so focused on wanting to do a deal that I'm overlooking obvious flaws because I'm just in deal mode. I want to get a deal. I want to get something done. And so I buy a bad company. If I look at my last empire build, 23 companies, one bad acquisition. And for less than 5% of my revenue, it created about 80% of my headaches for the next 3 years.
Ouch.
But I got the other 22 right. So one bad, 22 good. In baseball, Ty Cobb had the highest batting average, lifetime batting average in history. And it was in the so I think individual season, it was in the 400s, but as a career batting average in the 300s. Means he struck out 6 to 7 times or made outs, for every 10 at bats. In M&A, you got to flip it the opposite way. You need a 900 plus batting average. You can afford one bad acquisition in 20, but if you make a few, it'll derail you. So only buy good companies, know what good looks like, have a good, strong idea of what you're looking for before you start looking, and then be very, very disciplined on making sure that the company that you're looking for meets your criteria, that you're doing diligence, that the earnings as reported are there, and not phantom numbers that were recorded on a spreadsheet. And then financing. If you don't have capital, treat capital well, and look, for capital. There's plenty of non-traditional sources of capital out there. Capital should never be the reason you don't get a deal done, unless your deal is half baked. I can't tell you how many times someone will call me and say, Adam, my idea plus your wallet equals the biggest success in life. And I think to myself, the fact that they think I'm a money guy tells me they don't know my value, because my value is not my wallet. Money's a commodity, and I know where to go get it. What I know up here, that's the value. That's where the priceless, knowledge is, and the experience. And if we don't know where to get it, we need to learn. But if we think money's our problem, we don't have a good command or handle on what we're doing.
Let me ask the same thing slightly differently. So let's say I understand what good is. I have my acquisition criteria. Let's say I located a business that has a good debt credit service ratio. Now we need to basically go and acquire. So let's say we have some of the cash flow, retained earnings from the existing business to go leverage that as a down payment. Would you, like for your first deal, would you go for the traditional business loan, SBA, or look for somebody who would be interested in investing?
Well, I've done both, right? So I'm on the board of a company in an industry where a couple of young, very intelligent guys did what's called thesis-based investing. Researched an industry for about 6 to 9 months, put together a very detailed analysis, a book, about the industry, the growth trajectory, the theory, the segments, financial plans, the whole 9 yards. And then they went shopping, stick me on the board to have the old Gomer around who's done it a time or two, and go shop it, walk out of a family office with $100 million commitment, and then go build it.
Nice.
And so that stuff does happen in the real world. But you can't say, here's my idea, or here's my 3 pages of notes I wrote on my napkin. You got to do the work.
Yes.
And you can find capital that way. But if I'm just buying a business, if I'm going to engineer it, so I tend to focus on a certain profile and kind of business, needs versus wants. In an economic cycle, which good periods, bad periods, recessions, it's like a business that's focused on needs is a lot more stable. I need my roof fixed. I want a new sport coat. If I'm broke, I don't buy the new sport coat. But if my roof is leaking, I'm probably going to have to fix it. Needs versus wants. Contracted revenue versus project-based revenue. Contracted revenue means I'm billing my clients every month, and I find a new client and it adds on top of the clients I already had. And if it's project-based, then I sell them a product or a service. And, let's say HVAC, for example. So homeowner needs a new HVAC system once every 15 years. So once they bought it from me, the next month, I got 0 revenue and 0 customers, and I got to find new customers just to get back to the revenue I had last month, and then hope to grow from there. So project-based, not as attractive, as a recurrent contract, and so some examples of recurrent: pest control, landscape maintenance, bookkeeping, accounting, payroll services, stuff, those are some differences. Then I want low capital expenditures and high free cash flow conversion, because if I don't have any money, I need the cash that's in the business being generated to service the debt. And, you touched on debt service coverage ratio, so I'm doing 3 accounting roll-ups. Boy, I can find a $3 million accounting business that's throwing off $1 million in free cash flow a year, very high margin because the product is up here. I don't have a plant. I don't have equipment. I don't have inventory. I got brain power, some
And it's
computers,
recurring.
and some people. It's recurring. These companies need bookkeeping every month, not just their tax returns done at tax time. And so they're doing these services, providing them. I find a new client. It goes on top of the pile of clients I already had. My revenue's stable. It just keeps getting bigger. $1 million in free cash flow. But because there's 1.8 million of them in the United States, one of that size might be trading for 3 to 3.5 times. So let's say I'm going to pay $3 million for that business, and I'm going to be passive. So I want the person who's there to run it for me while I go find 5 or 6 more to bring into the fold. This person's going to be my CEO to run my platform. So my profile, my avatar of the first business is looking for someone in their 30s, 40s, maybe early 50s that wants to stay. They're a great accountant, bookkeeper, but they're not a buy and build guy. And so I'm going to do the magic and build the arbitrage while they run the businesses that I buy. It's a marriage made in heaven because I'm not an accountant. I don't know what they do. They don't know what I do. Put those skill sets together. So I'm going to let them become a rollover investor. Well, let's say I'm going to use an SBA loan. So SBA will let a current owner roll over up to 19%, and they don't have to be a guarantor on the loan. If it's higher than 19%, well, then they have to agree to be a guarantor on the loan, as well. But their equity now becomes my equity. And so we form a new holding company. We're buying this business. I'm going to own 81%. Founder currently is going to own 19. We now have 19% equity in our business before we ever started. And so there are a lot of SBA lenders out there. Some will say, well, I don't know, still want 20% down. Others would say, okay, in totality, I want 20% down, but I want you to have skin in the game. I want to see a check, give me something, give me $100,000, and if I don't have that, well, I go to friends and family, come be a passive investor in my adventure, but let's now look at the math. So if they roll over 19, I'm going to use 20 just for easy math. So $3 million purchase, they roll over 20%. That's 600,000. So they own 600,000. I now owe 2.4 million to close this business. Well, at a 10% fully amortized loan, 10 years, I'm going to need about 375, somewhere around there to service the cash flow on that $2.4 million note. 10% interest is 240. You roughly take half that again, so it's 360, add a little bit extra, that's around the right number without getting out a calculator, and so I need about 375. Let's just say I need 400. I'm buying a business with $1 million of free cash flow. And so I have a 2.5 times
over
debt
2%.
coverage ratio. If that business were to lose 20% of its revenue in a downturn, I'm still fine. I got tons of cash, coming out of the business to service it because it meets my profile, because it meets all of my criteria. So I probably am going to be buying this business and distributing cash to myself every year. My brother and I bought an insurance agency. We ran it. He ran it. I was passive, but we owned it for 15 years, and we were distributing money every year. It's like an annuity, and it's a professional business. And so we don't have plants and equipment and stuff. It's a professional services business, and then when we sold it for a fabulous multiple on top of that to a large strategic. So I can generate cash flow sometimes if I'm buying the right kind of company. Now, if someone says, well, I'm trying to buy a construction company and it's got cranes and dump trucks and, all of this stuff, and it makes, crappy margins to begin with, and I got to pay a high price because someone's selling me all the assets, all these trucks and cranes and stuff, but I got no cash flow to service the debt. Well, no wonder you can't get financed. You need to buy the right kind of company that has the right kind of profile with the right kind of structure put in place. And if you do these things, there's money readily available, to fund that kind of a deal. That was quite a tangent, but
Yeah, Two things out of that. One is what I heard that I did not realize earlier. You leveraging the 19% of rollover. So you got to build some kind of a relationship with the existing seller for them to be okay to stay with you and roll over.
So there's two reasons I would want them to stay. Well, there's a few others, but one is I'm passive. I'm not going to go in and run the business. I'm a passive investor that wants to do a buy and build, wants to do a roll up. I need somebody to run my company. I need someone who's going to take it out when it's time to sell and go with the private equity firm that buys it to run it for the next 5 years while I walk out the back door with my wheelbarrow full of gold. And so if I'm passive, I need an entrepreneur to stay. That changes the profile of what kind of business I'm going to buy.
Yes.
Once I have that person, I might change my profile to now I want to find businesses owned by 60 to 70-year-olds who want to retire.
Yeah.
They're not going to roll over. We're going to buy them out because I've got this younger person who's going to run the book of business that we're buying from these other people. They may have strong number twos or other people that can also help from a management perspective. And now maybe that person, I can use a large amount of seller financing because I'm 70, I'm selling you that same business for the 3 million. I don't need 3 million right now. I'll tell you what, I'd rather have the income stream. Give me $1.5 million cash at close. Give me $1.5 million that I'll put up on a note for 8%, 9% over a 10-year period. Now they get to clip coupons at my expense, every month, every year, and they become my bank. And I tell them, hey, if I default, they just simply take their business back. Best security for them, business they built and they already know. It's they could, now I'm using a lot of seller financing. I usually would use a combination, 19% rollover equity just to stay in SBA limits. And then maybe I get 20% seller rollover or seller financing. They're going to get the coupon and it's going to get clipped. And they're going to be a rollover investor with me. And now I'm going to go buy 5 or 6 companies. They're going to participate in the arbitrage. They're going to get a big second payday. And, end result is I have over 50% equity before I put a penny down.
Awesome.
And so there's multiple ways to structure a deal. And we just have to understand just the basic mechanics of how all this stuff works. But, again, if I'm buying the right company in the right industry, that has the right profile, financing is not going to be my problem.
I feel like I want to get up and run now. I'm so excited. I see what you mean. So the first company that you buy, do you leverage it as a platform? And the rest of them would be strategic buys with the lights off, right? Based on what you described in the book.
Correct.
Okay.
You just nailed it. Yep. First one's my platform. Subsequent ones, their role, I'm a strategic now because I have a platform. I have my company buying a company. Yeah. And I've changed my profile in that example to 70-year-olds who are retiring or 65-year-olds. And as a result, I'm turning the lights off. They get to walk out and go to retirement, which is what they want.
Fascinating.
But, in HVAC, the founders stayed because there was a high risk to losing the revenue. And so everything we do as an entrepreneur when we're buying stuff revolves around risk. If I'm buying a company and there's a high risk that once I buy it, the revenue is going to walk out the door, then I need to put some kind of handcuffs on that seller to make sure that revenue doesn't go away. And so rollover investing may be the vehicle that allows that to happen. Could be a consulting agreement, could be I force them to stay in the business and keep working for a while. Multiple ways to handle it. But
last question, Adam. Let's say I have right now a pest control company and we're not up there and we do not really have a platform yet because we're still in the process of creating all the back office and processes, SOPs and so on. Do you recommend to stop all that and go buy a platform or finish setting up the platform and then just go for strategic buys after that?
So these are very nuanced questions that are hard to answer from a generic perspective. So I would say just loosely all of the above. I've worked with entrepreneurs right now who are in an industry that's not very attractive. And I'm like, if you're going to spend 20 years at your age, I would not spend the next 20 years in the same industry I'm in. But we need a lifeboat. So we got to transition out of where we're at into something that's better for empire building. So let's keep our cash flow coming in the door doing what we've been doing. Let's start building that life raft that we're going to need. and then at some point we're gonna switch boats. We're gonna switch horses. And so maybe we sell that one now to somebody else, and now we've got a new company with a different profile. And so there is no right or wrong answer, and it's so nuanced and different based on circumstance. But I've done all of the permeations where
Awesome.
I'll keep the thing that I don't love. I'll make strategic pivots to build something that I do love, and now it works for me, because the mix is different. Or I'll build a lifeboat, slowly step over onto the lifeboat, jettison that thing, and then now I'll focus my energy on this because it has the better wealth potential.
Yeah. Just a feedback, reading your books just give you that perspective to see it, what's at the end. And it helps you with the strategies of where you are right now. Because if you don't have that merger acquisition experience perspective, you're trying to grow, and maybe you're trying to grow organically and maybe with margins, but the third one is it's a completely different ball game, and it's also could speed up your journey right now and actually position you to grow at a completely different pace.
Absolutely.
Which, yeah, it's a wow. Thank you, Adam. We're coming towards the end. Last word, anything you want to share with the audience, and also might as well share how they would find you if they have an opportunity to maybe collaborate with you.
Yeah. Hey, listen, LinkedIn is the best place. You'll find me on LinkedIn. I'm most active there. Believe it or not, there are fake Adam Coffeys on Instagram and Facebook. And I'm not on either of those platforms. So you'll find the real me on LinkedIn. My books are available anywhere books are sold. And I love hearing from people. I do my best to try to respond to people. And so I'll look forward to hearing all of you, and reach out to me on LinkedIn. That's the easiest way.
Awesome. Thank you. I'll ask my team to include the links in the description of this video. Adam, thank you very much for not holding back and giving back to the community. You're really making an impact. I look forward to get to the same place and make that impact on that kind of caliber, just like you.
Well, thank you. Thank you for having me, and good luck to all your listeners out there.
Thank you.